I would imagine that with all the capital waiting on the sidelines, we may not see the type of distress that we thought we would. I feel like the longer it takes for the cracks to show in multifamily, I know they're showing in maybe some other product types, but in multifamily in particular, I feel like there's enough capital waiting to get into apartments that there may not be a significant downturn as far as valuations go. With that bid ask spread, you're still generating a lot of offers on the deals you put out. Because I get your emails and we talk here and there. Can you give us some insight into the number of offers you're generating today versus 2 years ago?
Sure. And to your point on the distress, I agree. And I think perception is reality. I think that is another theme that came towards the end of NMHC when brokers like myself were saying the same thing. I don't think we'll see the distress that a lot of people are expecting to see. And then towards the end of NMHC, people started to realize that too and thought, well, I don't know if we're really going to see it. Still being patient though. And going to your question on the number of offers, we're still seeing this. I don't think the number of offers has really changed that much. If it's a quality asset in a quality location, we're still seeing 20 to 30 offers on these deals. And what's interesting now is that it's a lot of new capital, qualified buyers that own really, maybe it's the same deal or the same profile deal in a different market. So we're seeing this new wave of buyers that are coming from Dallas, Atlanta, Southeast, Northeast. Groups that have never looked in the Midwest are now looking in the Midwest because of our strong and steady, stable fundamentals. So that's one thing that's different is the fact that it's new capital chasing these Midwest multifamily assets.
Do you find in a lot of these Midwest markets, the locals are not as aggressive as some of the out-of-state firms that come in?
I do, and I feel like that's just been the theme really ever since I started. And I think that a big reason for that is the rearview mirror outlook, where someone says, I saw what this traded for 5 years ago, or I know what I could have bought it for 5 years ago. It's tougher to pay top dollar when you know that compared to someone coming in from Dallas who's never seen that and didn't know what it was 5 years ago. But the numbers pencil and they love the profile of the asset.
That makes a lot of sense. And I've seen that as well. That kind of reminds me of another thing that I'd love to pick your brain on. So every year, there's less and less mom and pop owned apartment inventory in the US. I don't know what that exact percentage is, but I know it's decreasing every single year. Are you seeing that a lot of the deals that are trading are maybe going from the hands of either a mom and pop or a bigger regional player to a larger national player? Are you seeing that type of transition happen in our industry?
100%. And it's probably one of the most attractive characteristics of an asset when we take it to the market is one that has been owned by a long-term owner, self-managed, that, again, perception is reality. So the perception to the marketplace is that it's underutilized in the operations. There's meat on the bone, there's upside, there's value add potential organically, as well as going in and upgrading the units. But most importantly, there's upside organically. So to answer your question, yes, there are a lot of groups chasing those types of assets.
And I don't think that's a trend that's going to stop anytime soon. Would you agree with that?
100%.
Do you see a lot of new entrants in the market that are kind of smaller mom and pops, or for the most part, are a lot of your buyers that are bidding on your deals these larger groups or more sophisticated groups?
It depends on the deal size. So we'll sell assets anywhere from $5 million to last year, our largest was $188 million. And so it really depends on the deal size. If you're in that 100 to 150 unit space, maybe $10 million deal, you're talking a $3 million equity check. That's different than a $20 million equity check. And the sources behind that equity are different, and the ways that that capital is raised are different. If you're talking $3 million, a lot of these high net worth individuals will be able to go to their high net worth friends and family and raise a few $1,000,000 and buy a $10 million deal fairly easily if they've had some experience doing so. Shift to a larger asset, $60 million deal, maybe it's a $20 million equity check. They're not going to friends and family to raise that for the most part. There's a lot of private family offices, wealth management, high net worth, whatever it may be, or semi-institutional capital that's funding this acquisition.
Do you find that the larger you go, the lower the return requirement?
I think that used to be, but because going to my statement earlier about there's a lot of patient capital out there, this isn't, I guess, a blanket statement, but when you're talking $20 million equity checks, that's semi-institutional, institutional capital, they're pretty sophisticated, and that's the capital that's sitting on the sidelines more than maybe the high net worth private individuals that can write a $500,000 check and still are very bullish on the fundamentals. It's the larger deals that they're tougher to raise the capital for right now, and it makes it, because of that, cap rates maybe not as low as a $10 million deal.
That makes sense. It's for everyone, but especially the larger groups. I'm sure it's a capital preservation plan. If you're not as sure of the fundamentals, or just you think there's a little more risk than there was a few years ago, it makes sense that you'd have higher return requirements today.
Definitely. And also the fact that that's the capital that also wants to get into the primary markets. So that's where they're still waiting. Whereas maybe the private individuals here in the Midwest have always owned in the Midwest. It's been great. It's been the best performing assets in their portfolio. And they're going to continue to focus on the fundamentals. They've got the liquidity, whereas $60 million asset, it's the capital that is also able and wanting to go to the primary market. So just a little bit more patient, but I think in the other, let's say in 2021, you'd have a lot of competition with capital throwing money at these larger assets.